Welcome. Today we're diving into IAS 2, the international accounting standard that governs how businesses account for inventory. Whether you're a student, professional, or just curious about financial reporting, understanding IAS 2 is crucial for interpreting company balance sheets and income statements. We'll break down what counts as inventory, how it's measured, and why these rules matter for accurate financial reporting. Let's start by defining what inventory actually is under IAS 2 and why it's so important for businesses of all sizes. Under IAS 2, inventory is defined as assets held for sale in the ordinary course of business, in the process of production for such sale, or as materials and supplies to be consumed in production or service delivery. In simpler terms, inventory includes goods a business plans to sell, items being worked on, and raw materials waiting to be used. This broad definition ensures that all relevant assets are captured, from finished products in a shop to parts on a factory floor. Understanding this helps businesses track what they own and plan for future sales. Let's look at some real-world examples. In a retail store, finished goods like clothing or electronics are inventory. In a factory, work in progress such as partially assembled cars also counts, and in any production setting, raw materials like steel, fabric, or chemicals waiting to be used are part of inventory too. These examples show how inventory appears in different industries and why it's a key part of business operation. Recognizing these categories helps companies manage stock and report accurately. Inventory is more than just items on a shelf. It represents a significant investment for many businesses and directly affects profitability. Accurate inventory measurement ensures that financial statements reflect the true value of a company's assets. Overstating inventory can mislead investors and managers, while understating it can hide potential profits. That's why IAS 2 sets strict rules for how inventory should be valued and reported. Heart of IAS 2 is its measurement principle. Inventory must be measured at the lower of cost and net realizable value, or NRV. This rule is designed to prevent companies from overstating the value of their inventory on the balance sheet. By always choosing the lower amount, businesses take a cautious approach, ensuring that assets are not reported at more than they're likely to bring in. What exactly goes into the cost of inventory? According to IAS 2, cost includes all expenses needed to bring inventory to its current location and condition. This means purchase costs, like the price paid to suppliers, as well as conversion costs, which cover labor and manufacturing overhead. Any other directly attributable costs, such as transportation or handling, are also included. This comprehensive approach ensures that the full investment in inventory is captured. Conversion costs are a key part of inventory valuation. These are the costs incurred to transform raw materials into finished goods. They include direct labor wages paid to workers on the production line and manufacturing overhead such as factory utilities and equipment depreciation. By including these costs, IAS 2 ensures that the reported value of inventory reflects the true effort and resources invested in production. Beyond purchase and conversion costs, IAS 2 allows for other costs that are directly attributable to bringing inventory to its present state. This can include transportation fees, import duties, and handling charges. However, costs like storage, unless necessary for production, administrative overhead, or selling expenses are generally excluded. This distinction helps businesses focus on costs that truly add value to inventory. Net realizable value, or NRV, is a critical concept in IAS 2. It's defined as the estimated selling price in the ordinary course of business, minus the estimated costs of completion and the costs needed to make the sale, such as packaging, marketing, or delivery. NRV represents what the business realistically expects to recover from selling its inventory, making it a key safeguard against overstatement. Calculate NRV, start with the expected selling price of the inventory. Then subtract any costs needed to complete the item and any costs necessary to make the sale. For example, if a product is expected to sell for $100, but it needs $10 in finishing work and $5 in delivery costs, the NRV is $85. This calculation ensures that only the recoverable value is reported on the balance sheet. Requirement to use the lower of cost and NRV is all about prudence. If the value of inventory drops due to damage, obsolescence, or falling prices, reporting it at cost would overstate assets. By writing inventory down to NRV, companies ensure their financial statements reflect what they can actually recover, protecting users of those statements from being misled. Sometimes, inventory loses value, maybe it's damaged, becomes obsolete, or market prices drop. When NRV falls below cost, IAS 2 requires that inventory be written down to NRV. The difference is recognized as an expense in the income statement. This approach ensures that losses are reported promptly and that inventory isn't carried at more than its recoverable amount. If circumstances change and NRV increases after a write-down, IAS 2 allows companies to reverse previous write-downs, but only up to the original amount written down. This means if market conditions improve, inventory values can be adjusted upward but never above the original cost. This rule maintains both prudence and fairness in reporting. The NRV rule is a safeguard for financial statements. By ensuring inventory isn't overstated, IAS 2 helps protect investors, creditors, and other users from relying on inflated asset values. This transparency builds trust in financial reporting and supports better business decisions. To wrap up, IAS 2 provides a clear framework for identifying, measuring, and reporting inventory. By requiring inventory to be valued at the lower of cost and NRV, it ensures that financial statements are both prudent and realistic. Understanding these rules helps businesses manage their resources wisely and gives stakeholders confidence in reported numbers. Thanks for joining this overview of IAS 2. Now you're better equipped to interpret inventory figures in any financial statement.